Hello and welcome to Investment Blueprint for Passive Investing, curated by experts at Motilal Oswal. I'm Muzammil and today we'll be talking about the top reasons why low-cost, index-based strategies are a smart choice for investors. We're with none other than Mr. Pratik Oswal. In our previous episode, we discussed the basics of passive investing, how it works, and how it can help investors achieve their financial goals. We also talked about the difference between active and passive investing and why passive investing is gaining popularity amongst investors. Welcome to the show, Pratik. Very happy to have you here today.
Thanks for having me. It's a pleasure and it's good to be here.
Awesome. So without further ado, I just want to get into the core question right away. And because you're here, I want to ask you, what are the top reasons according to you why passive investing or passive instruments are a better choice for investors?
Yeah, so definitely Muzammil. I can think of, I think 4 core reasons.
Yes.
I think there's lots of reasons, but I can think of 4 main reasons to why I think passive funds could be great for wealth creation purposes for investors. So, equity investing is very complicated. There are hundreds and thousands of stocks out there.
Yeah.
And each of them are extremely volatile. And it's very hard for a layman investor to really sort of figure out which stock to buy, which stock to sell.
Yeah.
Ideally, we believe that stock picking is a full-time job. And for someone who wants to create wealth, they don't have the time, they have a day job, right?
Yeah.
So I think mutual funds make life very simple for an investor looking to create wealth.
Definitely.
And within mutual funds, we believe that index funds, ETFs or passive funds can make life even simpler.
Okay.
Because you're basically you're relying on the wisdom of the market to create wealth.
Yeah.
We've seen that, in the stock market, prices decided by buyers and sellers. By having an index fund in a portfolio, you're basically making sure that you have the best quality companies in your portfolio.
Yeah.
And automatically when companies go bad, it gets removed from the index fund altogether.
Yes.
So I think by having a passive fund, you're basically, relying on the market. And we've seen over the last 25 years that the market has delivered phenomenal performance to our investors. So I think that's one big reason. The second reason to why we think passive funds, could also be effective is also because they're easy to understand or easy to select.
Definitely.
I think if you look at mutual funds, there are hundreds and thousands of mutual funds.
Yes.
If an investor wanted to buy a mid cap fund or a small cap fund, they had to choose. They would have to choose between 30, 40, 50 funds.
Yes.
And it's very hard for you to predict, which fund will do well over the next 3 to 5 years time. So I think for an investor who is looking to buy a mutual fund, a simple mid cap or a small cap index fund, does the job for their long term wealth needs. They don't have to worry about performance. If they had to invest for 30 years or 40 years, it's very hard for you to buy one particular fund. So I do believe that it makes selection very easy for investors who are looking to buy mutual funds.
Definitely.
The third reason is cost.
Okay.
We believe that index fund offer a lot more cost efficiencies. We believe that if you look at the expense ratio of mutual funds, index funds, ETFs have the lowest expense ratio.
Yeah.
And for what that means is that, a lot of your money is being invested in the underlying stocks.
Definitely.
So more of your money is working towards your long-term wealth creation. There's less fees that are being taken out. So with that respect, I think that's a big draw towards why investors like index funds. And lastly, fourth reason is, and this is again one of the reasons to why index funds, ETFs are really catching up or taking off, is that the return profile of passive funds have become very good.
Okay.
So I think there is not any difference between what you could make in the long run between an index fund or
very comparable, is it?
Very comparable to actively managed funds.
Okay.
So we believe that for wealth creation, you're not really missing out, if you're not buying an index fund ETF. So I think it's easy, economical, effective for wealth creation, and also you're using the wisdom of the market to really make your decisions.
You also spoke about that it's extremely cheaper. I wouldn't say economical more than the active products. Does it make a lot of difference at the end of the investment period? As in, if you're looking at a long-term cycle, the difference of expense ratio of an active fund over a passive fund, would the difference be a really big difference for people to consider?
Yeah, I think, the differences do add up over the long run. I think a 0.5% or a 1% fee, will not make a difference to someone who's investing for say 3 or 4 years.
Yes.
But someone who's looking for say investing for say 20, 25, 30 years,
Yeah.
that's 25, 30 into 0.5%, which is 15, 20%.
Yeah, definitely.
So we do believe that yes, cost does play a role,
Okay.
but I do feel that that's not a strong enough reasons to why you should select a passive fund.
Okay.
I think the main reason is it's easy and it's great for wealth creation.
Hmm.
Cost, to be honest, I would say that an actively managed fund does offer a lot of other advantages.
Yeah.
So I do feel
Constant
that cost is
curation.
important, but may not be the only reason to why you would choose a passive fund.
Makes sense. It also made me ponder that because it's constructed in such a way that it's economical, it's easier to understand, and it also guides the market in a way. Would you consider this to be a very good opportunity or a product for all the new to market investors, considering they don't have all these things in place? They don't know much about investing either, and choosing an active product would be really difficult for them. And definitely, when somebody is starting off early, they would look out for economical output out there.
Yeah.
Would you say that every new investor coming out should start with passive investments by any chance?
Yeah, I think it makes sense. I think for a newer investor, I think it takes some time for new investors to really find their way into which fund they should buy or which fund they should build their portfolio. So I do believe that index funds, ETFs, passive funds make life very easy for a new investor because you're getting a ready-made diversified portfolio of so many stocks. For example, if you buy a Nifty 500 index fund, you're betting on the Indian economy. You're basically betting on the top 500 companies in India.
Yes.
And by that definition, you're not really relying on one or two companies to do well or fail.
Yes.
You're basically generally sort of expecting the Indian market to do well over the long run.
Yes.
So you're getting a lot of diversification, you're getting low cost, and you're getting a fund which will always sort of I think over the long run do well in terms of performance.
Definitely.
So I do think that yes, for a beginner investor, it makes life very simple. I think they don't have to do a lot of research. I think one of the main tenets of investing is not, at least from our perspective, is to not, honestly, people spend too much time and effort in trying to figure out the right investment.
Yeah.
But the secret sauce is to invest early.
Yes.
You want to give compounding as much time as possible.
Yes.
So I think the earlier you enter, the better your wealth creation will be in the long term.
Yes.
And I think passive funds make it easy to enter early for new investors.
One thing also that people try to time the market, which apparently nobody can. And passive, when you do in a systematic way, probably could help us overcome that problem as well.
Yeah, absolutely. I think the biggest pitfall, I think one of the biggest reasons why most investors destroy wealth is that they're trying to make a quick buck by timing the market.
Yes.
They want to say that tomorrow the market's going to fall or day after the market's going to go up.
Yeah.
But unfortunately, my sort of 10, 15, 20 years experience and having read hundreds of books, I've realized that timing the market is very, very difficult, almost impossible.
Yes.
It requires a huge element of luck, So I do believe that for investors who want to time the market, yes, they can do it. But I think overall, you should expect to make the same returns as what the market makes.
Yes.
And that's why I think index funds, you don't really have to time the market because automatically if you have an index fund in your portfolio, the largest stock, if it does well, your allocation goes up.
Yes.
If the smaller stock goes badly, it gets thrown out of the index fund.
Yeah.
So I do believe that it's a very democratic way of money management.
Makes sense.
And I spoke about this earlier. Is that what you're investing in an index fund, say a Nifty 50 index fund, is not 50 stocks.
Yeah.
You're investing in the top 50 stocks of India.
Yes.
And the top 50 stocks in India, I don't know the future of the 50 stocks I hold today in my portfolio, but I always know that the top 50 stocks in India will be bigger 20 years from now than they are today.
Yes, definitely.
Which is why it's a great strategy for long-term investing.
Makes sense. When I think of investments or any form of investments, I also think about risk associated with it. And for everyone who's watching us here today, I would want you to tell us more about the inherent risks that come with investing in passive instruments. What do you think? Do they are comparable with active instruments as well, or how do they go?
Yeah. So I think and I'm going to talk about specific risk about investing in index funds or ETFs.
Yeah.
So unlike say actively managed funds, where you obviously have a fund manager who's doing the job of picking the right stocks in your portfolio. In a passively managed fund, your fate is decided by the market.
Yes.
So I think the biggest risk that you have as a retail investor is that is equity risk.
Yeah.
So I think when people say equity market risky hai,
Huh.
I think passive fund is what I think you should think about.
Yeah.
Because I think you are sort of exposed to market risk, and if market does badly tomorrow, your fund will also perform badly.
Yeah.
But we've seen that long-term investors who invested for say 5, 10, 15 years,
Yeah.
market has been extremely good, not only in India but globally.
Yes.
So I think market risk can be mitigated if you're a long-term investor.
Yeah, and you can rebalance if you can when it corrects. If the market goes down and if your horizon is 20 years, like you said,
Exactly.
then you can keep, rebalancing or averaging out whatever.
Absolutely. Yeah, I think the other way of mitigating market risk is to do systematic investing,
Yes.
which is through SIPs.
Yes.
I think one of the best ways of investing in equity markets is SIPs, because then you don't have the risk of mistiming the market.
Yeah.
Suppose the market is on an all-time high.
Yeah.
Instead of putting all your money, then it makes sense for you to sort of systematically invest it in an index fund. So I think yes, that's one more way of mitigating that risk. The third risk is the risk of obviously index funds. Their mandate is to track the returns of the benchmark.
Okay.
But because of if you add costs, if you add trading cost, GST, taxes, then there is a small difference between what the index will do versus what your fund will do.
Yes.
And this is called tracking error.
Yes.
So I think all investors should know that every index fund will have some tracking error.
Yeah.
Yes, for investors, it's very important for you to find the fund with the lowest tracking error. So make sure that, and I think today's market, most funds are pretty low, so it's safe. But I do believe that is also a risk that plays out in an index fund where, I think there will be, some tracking error, and investors should be okay with that.
Yeah.
There'll be some underperformance in index funds. And lastly, I think, there is also, could be risk of concentration also in index funds.
Okay.
Where the large companies will have very large stakes. So if you're buying a bank index fund, then your exposure to the top 3-4 banks is very high because they're very large. Or if you're buying a small cap index fund, you're buying less liquid companies.
Yeah.
So that might be a small risk there. But we believe overall, I think for a long-term investor, they don't have to worry about the risk involved.
Yeah.
You're basically putting your, I think expertise and you're putting the market intelligence in your portfolio.
Yeah.
And I think that is a very good thing to have.
Yeah, it's like building an IPL team, the best of wherever you can get together, bond them together.
Exactly.
And get the top 5 batsmen to play better.
And you don't have to worry about missing out on that company which does well, because automatically if a company does well, it'll be part of your portfolio.
Yeah.
And grow with your portfolio.
No, that was pretty insightful, and I'm pretty certain a lot of people who are watching us right now, a lot of base concepts for passive investments have been taken care of. With Investment Blueprint, we're also doing one more thing. That is, we're trying to inculcate an habit of learning on the go. So we've designed the show in a way where we're assigning tasks at the end of every episode, so that when the episode ends, they go and actually make some sense about it. Would you like to give away the task of today's episode?
Absolutely. So today's task for our viewers is to compare 2 active funds and 2 passive funds.
Yes.
So compare the cost structures of both. This is through expense ratios and also the strategy. And also after comparing the costs and strategy, I think viewer base should really give out their recommendations as to which fund they would choose for their investment needs as well as their risk tolerance. And I think this exercise will give a very good analysis of the cost savings that we could have when they're choosing index funds, ETFs versus the rest. And also I think it'll also help them have more informed decisions. So I think it's a very good exercise.
Oh, nice. So everyone, you know the task now. All you have to do is go compare 2 active funds, 2 passive funds, and write it down in the comment section whenever you do so. Along with this, I also want to remind you that Investment Blueprint for Passive Investing is a 10-episode journey taking you through step by step into how to build a portfolio with passive instruments. So if you've not seen the first episode, I would like you to go watch it and also continue this journey and watch the 3rd to 10th episode as well. So with this, we'd like to end our episode, and thank you very much for being a part of this, and hopefully we do it a 3rd one again.
Thanks so much. It was nice being here, and look forward to the next one.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.